I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE, symbol CRL, and the Pink, symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Victor Adair, co-founder of the Polar Futures Group. He's Senior Vice President and Derivatives Manager at PI Financial in Vancouver. His website, PolarFuturesGroup.com. Welcome back to the show, Victor.
Well, thank you, Jim. Good to be back with you.
Before we get into any specifics, what's your major overview of the markets?
Well, let's say it this way. We call it global macro, but I'd say one of the key things is that we have a new Federal Reserve under Jay Powell. This is going to be a different Federal Reserve than we had under Greenspan, Bernanke, and Yellen. I think Powell is set to change what we call the too low for too long picture that has been so dominant at the Federal Reserve Bank and other central banks around the world for about a decade now. Financial conditions have been very easy. I think that's going to change. A subset of what's happening at the Fed, or what I think will happen at the Fed, is the divergence between the policies that the Fed has and the policy that other central banks have will get wider. Certainly over the past number of years, I've thought that the central banks, with the activities they've had, some more than others, and let's put Bank of Japan in a special class all by themselves, have distorted or squashed price discovery in the market because of what they've done. They have suppressed risk, and investors, because of the really low interest rates that have been put into place by these central banks, have gone out and reached for yield. In other words, maybe taken too much risk just to get some sort of return on the money. One of the examples of taking a lot of risk is selling volatility. And I believe that the selling of volatility, let's call it picking up nickels in front of a steamroller, has gone on everywhere, from the pension funds right down to the guys trading in their pajamas at night. You know, the whole ream of things. We've seen maybe a subset of that even, a major, massive shift to passive investing, indexation, that sort of thing, use of ETFs, and certainly we've seen a high concentration in, say, a handful of stocks. We've got protectionist pressures out there. We call it trade wars in some senses. That's causing disruptions in the market. I wrote a piece a couple of weeks ago on so we have a weekly blog at PolarFuturesGroup.com where I was commenting about Trump, and I thought there were some folks out there that thought maybe he was just negotiating, And I said, well, the opposite of that is you're just in denial that what Trump is going to do, and he has been ramping it up since then. And of course, the one thing we're all wondering about is if it'll go to cars, where people, move cars from one country to the other. If he starts to talk protectionist pressures on cars, that's a major ramp up of that. Just maybe a couple of other things, Jim. We've had currency wars. Some countries want their currency down. I truly believe the Bank of Canada keeps more than a weather eye on the foreign exchange rate of the Canadian dollar vis-a-vis the U.S. And I think the bank likes to see the Canadian dollar a little softer. That acts as a shock absorber to some of the disruptions that we have. We've got geopolitical risk around the world, different elections. We saw what happened in Italy, where they got a new government in place. There's a major election coming up in Mexico, 1st of July. And here's one final thought. And one of the things that I'm really interested in from a macro perspective, I think that after more than a decade of interest rates being really, really low, that a lot of people have positioned themselves purposely or otherwise, on the expectation that interest rates are gonna stay low for a long time yet. And I think as the dawns on people that that's not the case, as interest rates start to rise, they're gonna have to readjust those positions, readjust their thinking. And for me, that's gonna cause, I think, major moves in some markets, which, of course, are the sort of opportunities that I like to look for.
In some cases, I've heard banks are charging car loan rates already 15, 18, 20%. Is that happening?
And what's the average term of a car loan? I think I don't know, 6, 7 years or something like that. Jim, in our lifetime, we have gone from seeing people hardly using credit to being right up to their neck in credit, and I've always thought that there was too much debt outstanding and there'd be hell to pay for because of that, but it's taken a long time.
We'll have more with Victor Adair right after the break.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test numerous targets located by recent groundwork is planned for early 2018. Please visit our website at rmroyalty.com.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the pink CYDVF, and on Frankfurt C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Victor Adair. Victor, given your macro views, would I be right in guessing you've been bullish on the U.S. dollar?
Yes, you would be. We have been trading the U.S. dollar from the long side. In other words, buying U.S. dollars, selling other currencies. We've been involved in Canadian dollars, euro. Right currently, I've had positions on and have positions on in the New Zealand dollar. We've been short of gold as being the flip side of a strong U.S. dollar. The Canadian dollar, it's down 6% in just 2 months. We're at a 1-year low here. The interest rate differential, which I was just talking about, between Canada and the United States on the 2-year government paper is at about 70 basis points. That's about a 10-year history. It hasn't been that wide in over 10 years. Elsewhere in the currency space, I've talked about the stealth strength of the U.S. dollar against emerging markets. You look at different countries around the world, whether it's Turkey or Argentina, God help us, Venezuela, Iran, countries like that. But just in total around the world, the emerging market currency index is down about 10% just from the highs in February. I think the strength in the U.S. dollar is going to persist, and I can picture, I don't know that this will happen, but I can picture that if the U.S. dollar strengthens, we could have another run to the upside like we had from mid-2014 to the first quarter of 2015, like in a 9-month period. The U.S. dollar index rallied 25%. That's the kind of move that I think we could see here, and that's why I keep positioning bullish the U.S. dollar.
If you think interest rates are going to go higher, how have you traded on that idea?
Well, in a number of ways. Directly, Drew and I've shorted the U.S. Treasury note. In other words, as the bond price goes down, that reflects rising interest rates. Certainly indirectly, we've been long of the U.S. dollar because I think one of the reasons that the U.S. dollar is doing better is because interest rates are rising in the United States, more than they're rising, if at all, in other countries, so that interest rate divergence continues to widen. So I think there's lots of, call it second and third derivative plays on rising interest rates. Yeah, if you just look around and you say who or what is vulnerable to rising interest rates, who's organized their affairs on the assumption that interest rates aren't going to rise. Okay, that's vulnerable. And where does vulnerability really show itself? Is with leverage. Who is really levered on some play, hoping that interest rates won't rise. So, if you see that vulnerability there, it's to somebody on the other side of the trade, that's an opportunity.
You don't seem to have a strong opinion on the stock market. Are you doing anything there?
I have. I thought the break that we had at the end of January, beginning of February in the American markets and most other markets around the world, after a really terrific run, honestly, throughout 2017, I thought that break we had at the beginning of the year was not so much a cry for help, what would be the expression, but it was just an example that maybe we'd gone too far too fast. And since then, if I've traded the stock index at all, let me come back in a minute here and say there's quite a difference between stocks and stocks. If I've traded the S&P 500 index, which is my favorite benchmark to trade, I've waited for it to kind of bounce back from a low and then maybe get tired and start to roll over, and I'll sell it short. So I've traded the market from the short side on these bounce back rallies. Haven't done much in the last month or so. There's been other things to do. But that thing about there's stocks and then there's stocks. I mean, right now we're seeing the U.S. small cap index surging on to new highs, way outperforming the S&P. And then you got the Dow. I mean, I think we're down 5 or 6 of the last 7 days on the Dow. So there's a real divergence there between the big caps and the small caps. You look at Shanghai. I mean, who cares what's going on in Shanghai? Well, I look at these things. That index hit a high back in January. It's down 20% from there. Then we have, say, the metals and mining index. That's about the same thing. January highs, down about 20% now. So, you talk about the stock market, it's a whole bunch of different things, obviously, different stocks, but, after this 9-year run in stocks, where I think a lot of people took what we call TINA view, there is no alternative, got into stocks. Well, now, with interest rates rising, and this could be one of those other plays on interest rates, we've got the 2-year yield on U.S. government paper is now well above the dividend yield on the S&P 500, and that's after 9 or 10 years of being the other way around. I think we're within a hair here, actually, of the U.S. 1-year T-bill yield being about the same as the S&P dividend yield. So if people are uncomfortable in stocks, they can maybe get more comfortable by getting into short-term interest rates or short-term government paper.
We'll have more with Victor Adair right after this.
Glance Technologies owns and operates Glance Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the U.S. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the U.S. and GET in Canada. Find out more at glancepay.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're chatting with Victor Adair. Victor, I see some agricultural markets like soybeans, corn, and wheat have been falling lately. Is that because of the trade war between the U.S. and China?
Oh, that's definitely part of it. And I think China is maybe the biggest importer of American soybeans. But we have seen the agricultural sector get whacked there. I think the strong U.S. dollar actually also helps, but really the focus has been on not only the tariffs, but the potential, for additional tariffs if this thing ramps up a bit. So markets are anticipating. And on the basis of that, we've had a good sell-off. When I look, however, I mean, here's one thought. Over, call it a 100-year period of time, technology keeps putting pressure on commodity prices. The farmers learn how to get more yield per acre of ground per dollar spent, and all that sort of thing. And technology, whether it's bigger tractors or using GPS to, go 24 hours a day in the field, technology continues to put pressure on prices. And just in the last few years, I mean, we've seen, for instance, the Bloomberg agricultural subindex. It's lost half its value just in the past 4 years. So it's more than just the latest weather, more than just to talk about trade, tariffs and that sort of thing. But yes, the ag prices are down. Maybe it's an opportunity. Maybe people that have done really well on tech stocks want to take some money off the table and, buy an agricultural index. But as it stands right now, the last couple of weeks, certainly, we've had some real pressure in those markets.
The Chinese counter tariffs to the U.S. seem to be targeting individual markets, places like Tennessee and Kentucky that make whiskey and bourbon, and those were the places where Trump had the strongest support. Do you think that will have an effect on this trade war?
Well, yeah, we've got midterm elections just a few months away, right? But let me give you this perspective. And again, I guess I mentioned it earlier. And I think people who say, oh, this is just part of Trump's negotiating style, from when he was on TV. This is what he does. He acts like a jerk and then he backs off or something. I'd say don't count on that. I think he is really deeply moved by the fact that the United States has had these massive and growing trade deficits with the rest of the world for 50 years. And whether he's right or wrong, and a lot of people will say he's wrong, I think he's likely to keep the pressure up more than people who hope that he's not going to are counting on. And as I said earlier, if he starts talking cars, like to put trade restrictions or surcharges on cars imported in the United States, I mean, that's a big deal. You look at the weakness we've had in the Canadian dollar here the last 10 days in particular, or let's say since that blow up after the G7. This is very much about Canada being vulnerable to their major market, the United States, getting tough with us in terms of what we sell them.
Oil prices topped out at nearly $73 a barrel a short while ago. They're down about 10%. What do you see with OPEC planning to perhaps increase production?
Well, that's been the big story here, I guess, for the past 3 weeks or so since we made those highs. The news started getting out, or the talk was out there that maybe what I call OPEC and friends had achieved what they wanted to achieve. They had got the above ground inventories back into a range where they've been in the last 5 years or so. I mean, prior to that, inventories were low and prices had moved higher. But then the magic is that where did the reduction in inventories come from? Certainly Venezuela's lost a lot of production. Libya had interruptions. Iran certainly interruptions. But the thought that, Trump is in fact, is maybe calling in a favor from Saudi to say, hey, how about producing some more, keep our price down? That's, I think, part of what has brought the market down from its highs. And maybe we were well overbought on the highs. The supply demand seems to be a little more imbalanced now. That when I say supply demand, I mean the inventories. Maybe other factors come into play. Certainly over the years we've seen geopolitical stress, as they call it, put a premium in the price of oil. U.S. dollar strength, I think, maybe puts a pressure on the oil side. But again, just like the farmers, technology keeps coming into the game. The whole business about fracking is what's allowed the United States to move to being virtually the top oil producer in the world. So, demand, yeah, more and more people are using oil, but we're getting more efficient in how we find it and how we use it. At the moment, let's say it this way. For the past year or more, 3 years, I guess, I've been trading crude oil from the short side. Lately, I have no position, and I'm focusing on other things, particularly currency markets.
Victor, you've been trading financial markets for over 45 years. If you could give our listeners one piece of advice to help them make money, what would it be?
I would say this, and this is maybe going to be counterintuitive, but this is my experience, that managing the risk or the risks of the trades that you have on or are contemplating or whatever is more important than the trades you select in the first place. In other words, somebody gave you a really good crystal ball that said, gold's going to go up, and you just jumped in and bought gold because of that. You wouldn't do as well as if you just flipped the coin about whether gold was going to go up or down and really manage your risks well. Let me give you this example. I'm remembering back in 1984, the U.S. dollar was on a tear to the upside. Ronald Reagan had been president for a couple of years, and I had a German client here in Canada who was convinced that the U.S. dollar was way overvalued and his beloved Deutschmark was really undervalued. So he kept buying Deutschmarks and he kept losing money, and finally ran out of his money in his trading accounts and put up more and lost all of that. And when he just sort of threw in the towel and went away, of course, at the early part of 1985, I think it was March of 1985, the U.S. dollar rolled over and went into a sharp fall. I think it fell by 50% or so over the next year and change. I mean, he would have made a fortune. So he was wrong on the market direction, and he had his timing wrong. If he'd just had his timing right, and so you have to have your, what can I say? You have your market calls. That's the trade selection. But then in managing your risk is, if you're losing money, take a small loss, get out. If you're making money, try to press your advantage. The old adage, cut your losses, let your profits run. Really hard to do. Believe me, I know it, but that's what you got to do.
Is the biggest mistake people make is become emotional about your investments, like the guy and his Deutschmarks?
Yeah, sure. Yes. But at the same time, I mean, I know I'm an emotional person. So, and sometimes I think here's another thing I'd say. You have to have a way of trading that suits you. If your fundamental DNA makeup is that you need instant gratification, that's how you have to trade. And you'll have to figure out a way to manage the risks around that. So, yeah, it's nice to say you'll read in a book that, so-and-so famous famous hedge fund manager, nerves of steel and, never cracked a smile or something like that. Just, this guy controlled his emotions. Well, then you'll have other guys that are very emotional and that throw furniture around and react and yell at people and, then to be really lovey on the other side. You have to find a way that suits you.
Victor, thank you so much for being on the show.
Jim, it's always a pleasure. Thanks for calling me up.
My guest has been Victor Adair, co-founder of the Polar Futures Group. His website, polarfuturesgroup.com. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet. Our YouTube channel is Talk Digital Network. Questions for the show or our guests, like Victor, can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.